Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. Our next investor conference is coming up, I think like 3 weeks away, the Planet MicroCap Showcase Vancouver on September 6 and 7, 2023 at the Fairmont Waterfront, Vancouver. We've announced companies, sponsors, speakers. Some of those speakers include Dave Barr from Pender Fund, Harold Leishman and Brent Todd from Canaccord, Ryan Irvin from Keystone Financial, Hamed Shabazi from Well Health Technologies, and Paul Andriola from Small Cap Discoveries. Be sure to go on our website to learn more about the event, register and attend. The website is planetmicrocapshowcase.com. See you in Vancouver. My guest on the show today is Gary Mishuris, Managing Partner and CIO at Silver Ring Value Partners. As I've mentioned on every show leading up, we have our conference, the Planet MicroCap Showcase Vancouver, coming up on September 6th and 7th, 2023. PlanetMicrocapShowcase.com for more information. And it is a great opportunity for attendees to meet with microcap management teams and ask them questions. We've covered this topic quite often here on the show, but one, we haven't in a while, and two, Gary's article, which is the same title as today's episode title, I think provides a solid framework, checklist of questions that every investor could refer to when thinking about how they want to speak with management. My biggest takeaway that stuck with me is asking yourself the following: what are you trying to accomplish in your interaction with management? I think most folks go into these conversations and their goal is thinking they can get the CEOs to give them information that's either borderline or non-public altogether. Most management teams are wise to those tricks and will lose respect for you as an investor because they get the game that you're trying to play. But asking yourself, what are you trying to accomplish, and establishing a goal, perhaps something along the lines of trying to build a relationship with the CEO or getting a feel of the CEO's values, and then constructing questions around that, I think can help you immensely with getting the results that you're hoping for. There's even more quality insight from Gary, so hopefully you'll see this isn't just another how to talk to management episode. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Gary Mishuris. Gary, thank you for joining me today. How you doing, man?
Good, of course. Thank you for having me.
Absolutely. It's great to have you on here. I apologize. Our episode should be sponsored by the T-Swift Eras Tour, the one thing that's keeping our economy booming, apparently, according to every article on MarketWatch and CNBC. So, listen, I didn't bring you on just to talk about that. I mean, unless you want, I'm not a Swiftie by any means, but
No.
We'll leave that for another day. But, you just published an article on LinkedIn that is probably one of, if not my favorite topic to talk about, not just on Planet MicroCap, but I have literally a whole series devoted to it. And that's interviewing company CEOs. Mm-hmm. Your article, the must-ask question checklist every investor needs. And yeah, we've covered this extensively on Planet MicroCap, but each time I do an episode around this, there's always something that we can learn. There's always a new question, a new way in which we can talk about it. But before we get into the nitty-gritty of your article and your insight there, it's been a while since you've been on the pod. I mean, how you doing? How's Silver Ring doing? Like, what's up?
No, I think, again, thank you for having me. I think, look, from an investing environment point of view, I think it's a tough environment for someone like me. I haven't been buying NVIDIA call options or anything like that. So that, hasn't been my thing, nor is it going to be my thing. So for a long-term process-oriented value investor, I would say the opportunity set is pretty challenging. That's not to say there aren't any, but look, I used to be at a private firm whenever a prospective client would say, how's an opportunity set? They would also always say, great. Well, not me, like the senior person say, amazing, you should give me money today. Well, I always thought that's kind of a BS way of behaving. And I would rather to be honest, and right now, at least through my lens, the opportunity set is not amazing at all. I wish I had more ideas is, another way of saying it. But enough about me. I'm happy to dive into this CEO because this is a good topic. And if you're a long-term investor like I am, and listening to this podcast, I think thinking about management and thinking about how to glean the right information in the right way is super important to a long-term investor. So yeah, happy to dive in.
100%. And thank you for transitioning into diving into the article for me on that. So here we go. Let's do this. To start off, I mean, for you, just high level for you, why is it so important to talk to management for you? And what is the main information that you are trying to get when you do speak directly with management?
Yeah. Well, let me start with a little story in my background, because I think I wrote this article kind of for my younger self because I started in the industry 22 years ago. I started Fidelity Investments and right out of college. So I graduated MIT, and I don't want to paint with a broad brush, but MIT folk are not necessarily known for their eloquence and their kind of social polish. So here I was, 21 years old. This is 2001, and unlike other shops, at least at the time, I have no idea what's going on there now, but you were given your own little coverage. So you were given your own industry where you were the analyst on that small industry, right? You weren't some associate bringing coffee or cranking Excel models. You were actually responsible for analyzing the industry, interviewing management, and coming up with the recommendations for portfolio managers. And I was god awful at that, and I was just, I was that guy who was very nervous, very self-conscious of being young and half to 1/3 the age of the CEO I was interviewing. And they had to bear me because I was the Fidelity analyst on their stock, right? And I remember asking like these long-winded questions, to show off how I knew, blah, 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 blah. And they're like, would you agree? Or, isn't that right? And I could almost see their eyes rolling, and, they would kind of, bear with me here. And then there was this portfolio manager at Fidelity, and his name was Rich Fenton. And Rich was born in 1979. Sorry, I was born in 1979, but he started at Fidelity in 1979, the year I was born. So he was there for a long time, okay? And he was actually Peter Lynch's first assistant on the Magellan Fund, I believe. I could be wrong, but I believe that's correct. And whenever I would do calls with Rich and other portfolio managers, Rich would be so good at asking questions. He would talk about baseball for like 45 seconds, say, hey, how's your team? Oh, I saw the Chiefs, whatever, right? And then he would say, how's business? And then he would shut up. And they would tell him everything he needed to know. Maybe occasionally he would prompt one or two other questions, right? So here was Rich, a 20+ year veteran, right? And talking like this much, listening like this much, right? And he was getting all of the stuff he needed to get. And here was Gary like talking and talking and talking and using up the 30-minute slot and doing a terrible job. So this is now I'm 22 years later into my career, so I'm not perfect by any means, but I've had a few hundred CEO interviews, if not more, under my belt. And I wrote this to my younger self, but also I think to other people who are in this kind of situation where they honestly just don't know. There is no easy, well-publicized manual for how to do it. So I thought it was good. It was on my Behavioral Value Investor Substack and on LinkedIn. So you can check out the whole article. But happy to dive in.
Yeah, well,
details. But I think, like, to answer your question, I mean, what you're trying to get out of the conversation really depends on your style, right? And so I'm trying not to prejudge that, because in writing this article, I want to focus on how to go about it as opposed to being doctrinaire about what your goal should be. So you could be an early stage VC, and you should be able to read this article and I think get something useful out of it. Or you could be a short-term investor, which I'm not, but you might be. And I don't want to judge because, listen, there's many ways to success in the market, and you should be able to get useful things from it. But what you're trying to get out of the interview is a function of your process, and I'll be happy to elaborate what I'm trying to get out of it. But how you go about it is kind of what the article is in big part about.
100%. And, just to hit on one thing you said from when you're thinking back on your younger self, because I've noticed this also, because one thing that we talk about a lot on here is like, okay, when you go into that meeting with a CEO or with management or the chairman, whatever, you don't want to just go in green. Like you want to, at a minimum, have some kind of basic understanding of the business, do some research and understand. But that's like the bare minimum, right? And sometimes I feel like you can also get caught up with like, you want to also like prove to management in some ways, like, hey, I know the business. Hey, I know what. And so, you don't be too hard on your 21-year-old self. You were, probably also trying to prove yourself in some respects of like, hey, I understand what is going on here, and to prove to them that like, hey, I am worth you spending this half hour or 45 minutes with me because I did my work, man. Like I'm not just, sitting here, having to be here.
I think that's right. I think also, look, most of us are not at Fidelity or a shop where essentially the CEO almost has to speak with you, right? And so, I mean, in that article, I spoke about kind of what are you trying to accomplish? And it's not just getting information, right? One of those things is to establish yourself, build a reputation with the CEO as someone who is thoughtful. And why do you want to do that? Not because you're trying to befriend them and be buddies with them, but because that might allow you follow-up calls. It might allow you access to division heads or other things, or the person might just be kind and share their insights in the industry on suppliers and competitors, on customers that might allow you to do current or future scuttlebutt research separate from this company, right? And so I think just kind of the goodwill of the CEO, which, there are many ways to do it, but I mean, you don't need to be like obnoxious and flatter them, about how beautiful their tie is. You can do it by respecting their time and showing that you're prepared. And a couple of quick stories because, well, two, one, when I was at Fidelity, Will Danoff, who runs the Contra Fund, was always a terrific portfolio manager guests and meetings. And like when you're a young analyst, you don't know who people are, who's good, who's not. And Will was famous for coming in a meeting, his hair looking all crazy, with a stack of papers. And he would, usually 10 minutes late, 5-10 minutes late, and he would, interrupt me and say, go through his papers, like, what do you guys do again? And I would be so embarrassed, right, as the analyst. But then I got it. Of course, he's super sharp. Of course, he knows what they did again. He didn't, randomly walk into a random conference room. He was there for a reason. He was trying to go back to basics and zoom out and get just a very high-level update on what the management thinks that what the company is. And there was one time where essentially the CEO started answering the question and he said, okay, but John said so and so. And it's just like, well, I apologize, but John's passed away. Yeah, that's fine. But John said, right? And so like, he wanted to make sure that the story was the same or understand how it changed. So that was kind of story number one. Story number two is, a long time ago, I was part of a roaming band of small cap investors, right? And I wasn't the organizers, but they were really nice guys, and they invited me to join on these like visit 3-4 small caps in a day, just do the trip. And there was almost zero preparation, right? I felt like nobody was prepared. It was just basically, hey, we're gonna learn, as we go along. And I get that because they were like, we don't even know if we want to invest in learning the company. I just go and meet with them, and from the vibe and the information we get in that hour, then we'll decide later. So they'll walk in and say, hey, tell us about your business, kind of like that. And I found that while that might be the right approach for many, like just for me, it just didn't work. I got nothing out of those meetings. I just wanted to like browse on my BlackBerry at the time. I'm dating myself. And I'm like, why am I even here? This company sucks. Like if I'd spent 10 minutes skimming through the annual reports, looking into numbers, I wouldn't even be here. Like not in all cases, but in some cases, right? So I think there's many approaches. And again, you have to figure out like what works for you.
Absolutely. Well, I mean, not to jump around, but like one of the things that I thought like I took away from your article that I think is probably something I learned the most is really what you're trying to accomplish when you're with a CEO, because I think that can always get misconstrued, even when we talk about it on here, even when I interview CEOs as well, is that are we trying to get like little tidbits of information that maybe aren't in the press release or aren't in the Q's and K's, like that like, for one, that's not what I'm trying to do. I know that, but I haven't put into words how you did so eloquently, where you say here, you are trying to get a feel for the CEO's values and the company's culture and the intangible attributes of the team that don't come through purely in the numbers. Like, that point right there, I think, is probably, if there is one takeaway for why you need to be talking with management teams, it's that, because you're not going to get something different that they can't publicly talk about, because they can get in trouble for that. So don't expect anything like that. But if your goal is to get that out of it at a minimum, that's where you win.
Yeah, I mean, and by the way,
there's more, but
yeah, no,
I love that point.
The year I entered the business, 2001, was the year Reg of D was passed, which is for the regulation of fair disclosure, fair disclosure, which basically says that a company can't tell one investor that's something that's material that it hasn't disclosed to all investors through a filing or through public disclosure. Before that, people at big firms, it was called dialing for dollars, right? People would totally call the CFO and say, "How's the quarter? Are you going to beat numbers?" Now, when the Reg of D was passed, people still do that, by the way. I'm sure it's happening this moment. Like, someone is talking to a CFO, instead of saying, "Are you going to beat the quarter?" they're looking for clues, body language, sentiment, tone, whatever, And I would have to say that any CEO or CFO that I would respect has got to hate those people. Not on an individual as human beings, but like, man, you taking my time to try to get weekly and monthly trends, you're such a waste of my time. Please, like, don't call me again. That would be any self-respecting CEO who's thinking about managing a business should be thinking that. Now, there are people who aren't. They love manipulating markets. They want to get their stock up because their options expiring, whatever. But those aren't people you want to be in partnership with anyway. So I think, while there are a lot of people who do still dial for dollars, just try to stay within the letter of the law, I would honestly recommend that, unless you're really a short-term trader, you stay away from talking about short-term trends. And I think one of the ways I get calls, I don't work for Fidelity, I have my own firm, it's a small firm, but I say up front two things. I'm a long-term investor, and I'm not going to ask you about the quarter, right? So I kind of make them feel at ease. I say, "Oh, I'm short. I'm not going to ask you about the quarter," and I tell them a few things about myself. But I think the key people I want to talk to are relieved to know this is not going to be one of those, "Hey, and in August, the first couple of weeks, were they slightly better than July? Would you say? Would you give me a wink? If Twitch, like, come on, really, grow up, So, sorry, I'm not trying to hurt anyone's feelings who's listening, but yeah, grow up if you're doing that.
But I don't think you should. No, there's no apologies necessary. At the end of the day, like, it is just a waste of it. It's a waste of energy. Like, and also, like, from the CEO's perspective, it's like, yeah, no, look, we publish, we put out our Qs and on this date, and yeah, you'll see for yourself. Like, like, how as a CEO are you supposed to respond to that? Because you can't really respond any other way,
right?
Well,
back to what you're trying to accomplish, and like the soft things that you should be looking for, I think, is, look, and I don't have data to prove this, but my strong sense after over 2 decades of investing is that the people, first of all, you don't become the CEO by being the most, like, self-deprecating person or the humblest of people, right? You need to have a certain amount of self-confidence, because at one point you have to, like, edge out some other competitor for the job or something like that. So there's going to be a natural selection bias that the people you're talking to are confident in themselves, and they should be, hopefully as deserved. But I find it always to be a really positive sign when that confidence is kind of balanced with humility. And one way of observing that is they're giving you some negative information about the company. And it's not like, in an interview, like, "What's your biggest flaw?" It's like, "I work too hard." Not like some straw man that's meant to check the box, but they're honest about challenges.
Yeah.
So like one of the questions I have, and I'm just pulling up the Substack article here is, who is your toughest competitor and what makes them the toughest? And if they say, no, we're the biggest, we're the bushiest, nobody comes even close to us. Like and then you look at their returns and they have 8% return cap, right? That I think that either they're delusional, they're just like to brag with no base. Right there and there, you learned a ton about the management. Versus like a better answer might be, listen, we do have an edge here, but there's another competitor or two that they have something we don't have, and here's how we're mitigating that, or trying to create that, or trying to focus on a customer segment where that's not important, right? But that kind of an answer shows two things. One is there's some honesty involved in the conversation, even if it's not to their advantage. Number two is they're kind of aware of challenges and they have a plan to address them, which is good because all businesses face challenges, right? The question is, do you as the investor know them, and does the CEO know them and is doing something about that? So like that's the kind of thing that I think when we listen to conference call replays or read the transcripts from earnings calls, you're not going to get as much from that, because a lot of times the questions are softballs, or they're about how the quarter trended intra-quarter, how the quarter is trending after the end of the quarter. Like 40 to 60% of a usual conference call is completely useless to a long-term investor, and occasionally there'll be a nugget here or there. But anyway.
No, that actually inspires me when it comes to the interviews that I do with management here, because one question I usually always ask management teams is, what, in your opinion, what would you say are the company's downside risks? And it's a question that I think I like, because you can learn a lot about management from that answer. I've had a couple that have said, we don't see any downside risk here. Like, this is
all upside, buy now, and
all upside. Like, everything's gonna be great. But one thing I've noticed, and I've been thinking about adjusting it, is because one thing that almost everyone says is, well, there's always execution risk. It's like, oh, okay, like obviously, right. And so when it's just execution risk, it's like, okay, well, am I really learning anything from that question, right? And I think a better way of asking that I'll probably do from now on is like, well, what would you say are the company's challenges, the real challenges, and how are you trying to allay some of those challenges, or how are you addressing them? I think that would probably be a better way of doing it.
Yeah, that's a good question. And as I wrote in the article, I think as long as you're sticking to short how and what questions,
right,
it's hard to go terribly wrong.
Yeah.
Because I think a lot of times they're non-threatening and they're open-ended. Now you have to be careful. Someone's going to filibuster you and take a 45-minute slot or whatever and basically go on the rampage. You have to be kind of a gentleman bulldog or a lady bulldog and say, listen, I'm totally into this, and what you're saying is terrific, but I want to be respectful of your time, and there's a few other things I want to get to. Can we come back to that or something, right? Just to kind of stop them from filibustering on their pet, answer and not actually getting to some things. I mean, another thing, like from a culture point of view, right? People talk about culture, right? What is culture anyway? Whenever sometimes people so much talk about culture, it feels like they're eating yogurt. There's a lot of culture, but I find like a question that helps me is, tell me about some non-financial ways you're trying to motivate your employees, right? What are some non-financial ways that you're trying to, I'll give you an example. So there's a company I used to follow, it's still around, called Ecolab. ECL is the ticker. I don't own it. I'm not recommending it. It's just I used to follow it as an analyst, and they used to it was a very sales-driven company, and they used to give their top salespeople a leather jacket. And that leather jacket might be worth $50, $100, right? The financial value of that was de minimis. But these were alpha males, they were mostly guys, and they were super competitive. And the value of showing the other alpha males that, no, I am the alpha male, look at my jacket, I was a top salesperson for month, quarter, whatever, that had such a huge ROI on that, and it's such a keen understanding of what motivated these people, right? So that's one example. Another, I'll give you, again, don't own it. It actually it's no longer public, got acquired. There was a company called Valspar. They had industrial coatings, and they were trying to inspire plant managers to care about working capital, right? So they, on their business cards, would put various gold three-dimensional kind of awards for different categories, and one of them would be inventory management or something like that. So when you go to the the plant manager get together once a year, and you give your card to the other guy, he sees like you have 2 gold stamps. Oh, you're the man, right? So these like little clever ways to create rewards, tells you management is thinking about motivating behavior, and it's not all about just hanging a bunch of money bags in the hope that that's enough.
Absolutely. And I think that's some incredible insight in terms of asking about culture, because that's definitely, I don't even really ask it on the due diligence, because it's like, all right, how do I, one, it's like, okay, how, what is the company's culture? How do you inspire to have, a place that people want to work at? And then they could say something beautiful and glossy, and then you go on Glassdoor and it's like, we absolutely friggin' hate it here, or something like, you know what I mean? But yet you put it out on our,
Right.
interviews already out there, so that's a tough one. It's tough being able to like glean from them, like on culture side. Like there's like learning about the CEO, you can get some things, but culture side, that one's hard.
Well, I think a question that I find informative is, how do you deal with your B players?
Okay.
Because so think about an organization, right? Any industry, right? There's the stars, the people who are doing really well, and there is the problem people, the people who like on performance improvement plans or whatever, and or people like, and then there is the B players. They're okay, right? And I think any manager who hasn't thought about this is just like not doing their job. And there are some cultures, right? Think about like the Silicon Valley cultures, where their whole idea is to only have the A players, right? B players gets you fired, essentially, right? And there's there's a bunch of books about this, where they talk about but that defines a culture, because they figured out that A players want to work with other A players. They do not want to work, I don't know, when I was in college, right? When someone is like, free riding on your work on a group project, if you are the A player, at some point you get tired. You're like, listen, man, WTF, listen, why don't you do some work, right? But, you can't say that to a B player, because they are doing some work. They're just not that great. They're not terrible. Like, okay, right? And so essentially most cultures just have mostly B players, right? And they'll have a few sprinkling of stars and some problems that they're trying to solve, right? But that's the answer you should expect from most companies. But occasionally you'll come in and say, you know what, we actually transition them out pretty quickly, or they can't survive because X, Y, and Z would happen if they were a B player, right? And so that informs you. So if you don't get anything informative, that means that it's a normal bell curve with mostly B players. But if you hear something different, then your ears should perk up and like, okay, this is a little bit different. I'm gonna follow up on that.
Absolutely. So, I mean, in the same article you put in, the actual questions that you like to ask companies, as well as to customers, suppliers, business economics, capital allocation. I mean, these are great questions that definitely, I'll put the link to this article in the show notes and whatnot. Of all the questions and all the topics that you want to cover with management, like you said, sometimes you don't have that much time, a half hour. Right. I mean, I run investor conferences. That half hour goes quick, right? Yeah. And they sometimes get stuck on 1 or 2 questions and that's it. So for those that, you may not have that much time with the CEO, what would you say is the one question, one topic that, at least for you, is the most important that you want to try and get out of that in the amount, and if you only have that short amount of time?
Yeah, I would definitely start with competitive advantage and how they're planning on executing around that for the next 3 to 5 years, because that, while that can just be an invitation for them to just talk and give their prepared bullet points, if they're not addressing the substance, right, then that they probably don't have a competitive advantage or don't know what it is. And I think to a degree, so I think that, like your strategy should be around your competitive advantage, right? Like or around building a competitive advantage or expanding a competitive, right? Right. So if you're not aware of your competitive advantage, or can't articulate how your strategy kind of works with that, that's super important. And I think, again, in a 30-minute meeting, that answer could be a 15-minute answer right there and then, and that's fine. if it's a good answer. If it's if it's like our people, our edge, it's like, well, unless you can demonstrate that, and I don't know, some tangible way in that, and that's probably true for like 1% of companies, if that. The rest, I mean, have the same people from the same, right? They're not the edge. I mean, there's our best assets walk down the elevator. Okay, fine. Tell us something unique that makes you different, that allows you to earn excess returns, that allows you to level up, right? And then the other question I would say is the capital allocation framework question, and then ask them to tie it to how they historically executed that. Because so one thing that I didn't put in an article but is worth noting is you try to separate people who are thinking about it's industry standard, right? So it's industry standard to give certain cliche answers, versus first principles thinkers, right? So like the industry standard answers might be, for capital allocation, well, we have a dividend policy, we consider the board, and we buy back stock to offset stock option, creep or whatever, right? And we consider acquisition, right? And that's kind of a boilerplate generic answer that could be true for any company. What you're looking is, when asking that question, is two things. One, you're trying to look for, is this, answer specific to this company and unique? Like, think about some better cat, like a Danaher or a Roper, or whatever, or a share cannibal, right? An AutoZone, right? These are companies that are doing things differently. And like the first two cases, they're acquiring assets. They have that's part of their strategy. They have criteria. That's the main outlet for their free cash flow. In the case of like a share cannibal and AutoZone, they're like, hey, now we deploy all our capital to buy back as many shares as we can, right? Those are different answers than the standard balanced scorecard, some dividends, some share buybacks. And then by asking them to tie it back to their actual historical actions, you're kind of laying bare their true beliefs, right? So if you look at data, almost every company buys back stock when it's high and slows down or eliminates the buyback when it's low. Why? Because people are human, and when it's scary, you, the investor, is not the only one who's scared. So is the CEO, right? And the board, right? And the cover your ass mentality is, let's wait for better business visibility. Now we'll buy back more shares, which is common investor mentality, right? Let's wait for a catalyst, right? They're all the same as you, except they're inside. Yes, they know how business is trending, but they're still scared, right? And what you're looking for is the outliers, number one. But also the other thing I've come to realize over my 2+ decades in the business is cheap only works under certain circumstances, right? As an investor, let's say you have a cheap stock, whatever, it's 7-8 times free cash flow, cheap, right? And let's say it's not declining, because like, why would a stock be at 7-8 times free cash flows? Maybe it's a declining stream, melting ice cube, but that's not the case. Well, if a management takes $1 of their free cash flow and turns it into 50 or 60 or 70 cents, then that valuation could very well be realized, right? Or if the management is unwilling to be its own catalyst in the face of an obscenely kind of undervalued equity, even with a healthy balance sheet, then maybe the price to value gap will close. But remember, like, at least in the smaller stocks, where I don't spend my time exclusively on smaller stocks, but certainly it's a big part of my hunting ground. This whole like dichotomy in the market is you have indices, right? There are bigger and bigger components, right? And there's more and more flows going to indices. And then there are these more and more orphan smaller companies that are less followed, where there's less flows. And so you can make an argument that they're going to be less efficiently priced. And if the price to value gap, used to close on its own for some of these companies, right, in a reasonably fast amount of time, that's less of a case now, I think. So you kind of want to make sure that if you're going to get involved with a company, that at least management is going to help close that gap directionally through thoughtful capital allocation.
Absolutely. So, in going through the article and looking and thinking about it a bit further, and I say this with all due respect, but it also feels like, this is great stuff for, maybe that second interaction with management, like build, like when you're just first meeting them, building that relationship. So let's maybe take the article a step further from the perspective of like, okay, let's use the scenario. Let's say you've had a couple conversations. Let's say maybe you took a starter position. You're looking to kind of build that position out over time. But now that you own, you're an owner in the business, now I'm monitoring much closer maybe than I was before of like certain things that the company is doing or things that management has said. And maybe it's things I don't really like. In your opinion, what's the best way to have a conversation with management, be critical without being accusatory?
Yeah. So first of all, again, it has to do with your process. If your process is to be an activist and there is an or else, and you own 10% and you're going to nominate a board slate, the conversation probably should be different than if you are not intending to do that. And so let's take that off the table because, let's say that you're trying to understand, the management, let's say there were some actions you didn't understand in the context of prior discussions, right? And so you just have to say, listen, we talked 6 months ago and here is what my notes say, and here's what I observed. So maybe just how does what you did, reconcile what we talked about as the plan and what made you change your plan going forward? And then just listen. And I don't think your job is to argue with management, because
agree.
Again, if you have a what else or you have or there is a credible threat, then sure. And I would say in my started silvering 7 years ago, I had one 13D activist situation, and I'm not going to mention the ticker, but the situation was as follows. They changed CEOs, and a big portion of my thesis was there was a lot of excess cash, and that was a source of downside protection for the thesis, right? And this new CEO said, we're going to do some acquisitions. And I'm like, oh no, you're going to throw away my cash. And now my downside protection is going to evaporate potentially. I didn't sign up for that. And I happen to own a fair amount, or percentage-wise, of the shares. And at first I listened, and I was told how amazing that's going to be. And, but like, come on, really? Like, we know the base rates of acquisitions are bad, and some microcap CEOs not necessarily an immediate candidate to overcome those base rates, right? So I said, listen, okay, I hear you, but I'm a meaningful shareholder, and can I talk to the chairman of the board? Just I talked to the chairman. The chairman was gung ho about this acquisition. Like, I said, listen, I don't think you should be doing this. I don't think your investors expect you to do that. I don't think you've built the credibility to do this. I think that you should be doing one of two things: either buying back a lot of your shares. But if you don't want to do that, I think that another fellow just sell the company. You have a business that's subscale that could be more valuable in someone else's hands. But at the very minimum, please do not touch the cash. It's not your cash; it's our cash, right? And And the CEO basically, not in so many words, let me know that he was wise and didn't need my counsel. The chairman, shared his thoughts on how, experienced and worldly he was. So okay, and so I said, like, I got lawyers and I filed a 13D, and I said, all right, let's go, because I don't think you have the support for this. I don't think people want you to do it, and I don't think what you're doing makes actual sense, and I didn't get on the board, which kind of was my main goal was don't touch the cash, but I didn't do any acquisitions, right? So but that process, that's not an enjoyable process for me. Like, there's some guys that wake up and they want to get on CNBC and they want to badmouth some CEO or whatever. Like, I'm waking up and I want to do some bonsai pruning on my bonsai trees, right? Or, read, something thoughtful or whatever. I'm not looking to pick a fight. But if someone is going to come at me and basically threaten my partner's net worth by potentially devaluing the business that we invested in on a very different set of assumptions, I'm going to stand up for our rights. And so I think that for most people, if you're not going to do that, just listen. And if you come to the conclusion that this person either dishonest, don't know what they're doing, or frankly are delusional about the reality of the situation or their own abilities, unfortunately, your main kind of avenue is, walking away.
That is such great advice, man. No, I mean, look, this is everything that you just said in that anecdote. If you know, is that I mean, that's why it's so important to have a relationship with management. No one's saying you got to be their best friend. No one's saying that you know you got to cozy up to them just so that you can get like. As long, I think every CEO I've ever interviewed, had interaction with, you know, as long as an investor is respectful of their time, ask respectful questions, it's coming from a place of respect, even if they're going to go critical because of maybe a miscommunication or maybe the thesis has changed or something has changed from a previous conversation to where the company is now. As long as you're coming from a place of respect and just, you know, not trying to get them or call them out, like you're going to get the kind of differential insights that you're trying to achieve.
Yeah. And I think looking, when you asked like second and third conversations, it's almost kind of, when you first said that just now, I'm like, oh, great idea for a next article. I'm like, the problem is it's so specific to the situation and your process. And I think you're monitoring change, right? What's changed? And that's going back to Will Danoff and the stack of papers and what do you guys do again? Now, Will is talking to 10 companies a day times 360. So everyone's style is a little different. But I think in general, like understanding positive and negative change. I was thinking about this the other day. You know, I know we're coming towards the end, but like I was thinking about selling and how I'm not a great seller, right? Oh, and then this thought came to my mind. I can't think of making a mistake selling a company whose fundamentals became worse. It never happened to me in 22 years. Now, you know, and the temptation for value people, you know, in the tribe is, you know, as fundamentals get worse, is for them to say, well, the price is lower, probably, right? You know, and just well, it's cheap, right? And maybe I'll end with this one example because it has to do with management. So there was a Canadian company, won't say the name, I don't own it, but my prior firm, we owned it, and it was owned by managed by these two brothers who owned a good chunk of it. They had like it was like $1 billion market cap or something like that, and they had 100 million between the two of them, and that kind of made me think that incentives were aligned, right? And then on one call, they announced that they spent 100 million or so of the company's money, which was like 10% of the market cap, on buying this Chinese company out of nowhere because they felt like they had the weakness in manufacturing in China, and so they decided to buy this company. And they were asked on this call, like, well, how do you think about what's your return on invested capital will be? And they said, listen, we just haven't thought about that. We just needed to buy this capability. And I wasn't the questioner, but I got off the call. I remember walking into I was a portfolio manager on a focused value strategy. And I remember walking into an analyst's office and said, I'm like so conflicted. It's cheap. I mean, by the way, I bought it at 6 times earnings and free cash flow. It was still at 6 or 7 times earnings and free cash flow. I have a really hard time selling companies at 6 times free cash flow, right? It's just hard, you know. And they had, I thought, some moderate competitive advantage. They had some, like it wasn't a shit company, forgive me my French. At least I didn't think it was. But that comment, like we spent 10% of the market cap and we haven't even thought about what the returns might be. In some ways, it was really helpful that they were honest. You know, a more polished CEO would have come up with some bullshit, PowerPoint answer of what their investment bankers said or whatever. But I sold, and I look back. I was looking at it was a $22 stock. I saw it was $4 the other day, right? And yes, I'm doing a little bit of this, but only because I get my sells right so rarely. Usually my pattern is I sell something because it's expensive, and then it doubles from there. And I sit there and saying, I'm such an idiot. Why did I sell? Or was I an idiot? Was I just, right? I mean, you're sitting there kind of like trying to be introspective about was your process right? Was your process wrong? But here it's like crystal clear example where management revealed themselves to be poor stewards of capital. They're not thinking about returns. Doesn't matter if it's cheap, because like you're not getting that cash back, right? And you don't know how they're going to spend it. Anyway.
That was kind of a great anecdote to end. I mean, because I think I want to point everybody to the article. It's a great piece. It's if you've never written down the types of questions that you do want to ask management, or, you want to just better your process or kind of go back to basics on like, all right, well, what are my main motivations for why I want to talk to management? I would go check this article out. It's really fantastic. So Gary, final thoughts, hey, listen, not to be self-serving or anything. I'm doing an investor conference in about a month in Vancouver, Planet MicroCap Showcase, September 6th and 7th. There's going to be investors there going to meet with management teams. What are some of your final thoughts on the differences in the types and for you when it comes to no matter what the market cap is for a company? Do your questions adjust, or does your thought pattern change at all? Or is everything that you put in this article work for any company at any stage of its cycle?
Obviously, assuming it's a first interaction, I would say it works, because I think this whole, so what's the difference in a micro cap and a mega cap, right? The CEO has more direct involvement in more of the company, right? So they should know more minutiae. They should be more, involved in execution of things. There is should be a flatter organization, right? They probably should be in one or maybe at most two businesses, usually, right? They shouldn't have 7 divisions. Sometimes they do. But I think most of it, it's people are people, companies are companies. They have, they have cash flows, they have advantages, they lack advantages, they have balance sheets. So I think going through that and thinking about, the key issues is a great way to start, and then zoom in. And I would leave you with this. I think if anything, so why are microcaps more inefficient? One is obviously liquidity, right? Then there's also perceived, and sometimes correctly perceived, fragility of the business, right? Most microcaps are somewhat more fragile than Visa, Google, Master, whatever, Microsoft, right? But there's also, you're just gonna get a less polished answer most of the time, and you're gonna get a sense, is this person for real? And I'm a very process-oriented guy. I have this owner's manual where I'm in depth in my process, and all my partners and prospective partners read it. I hope they at least look at it. But I would say if you experience enough, at some point you'll have to trust your gut. If you're getting the creeps listening to a person, just move on. And on the other hand, if you find yourself saying, okay, this is a little different. I've met with 100 microcap CEOs, and these 3-4, they just a little different. Different is not always great, but at the very least, that they're not in that fat part of the bell curve, and different, it probably is good in this case.
Very good. I think that's a perfect place to end it. Gary, where can our audience go and follow you, subscribe to your newsletter, as well as I think, are you on Twitter? I don't know if you're on Twitter, but
I am the last person on Twitter. So
sorry.
I am not X, Schmax. I'm not there. I know you try to convince me. You're not the only one. I'm cool. I'm not a bird. I'm not gonna tweet. I know I'm the minority of one, but whatever, it's my own, mental flaws. But so I write on Substack. It's weekly articles. I don't spam people. I don't, I'm not selling some core. I don't have anything to sell. I enjoy writing. I also find it crystallizes my thoughts. So it's behavioralvalueinvestor.substack.com. I'm sure you'll put a link in there. So that's probably the best. I'm also on LinkedIn if you want to connect. I write, I also publish some of those articles on LinkedIn as well. So happy to connect in either location.
Perfect. All right, dude. Well, with that, Gary, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next chat.
Likewise. Thank you so much for having me.
Thank you. Podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.